Good morning, everyone. I'm Vince Lanzi. It's Friday, 7:22, and this is the Gold Fix Market Rundown. On the homepage, we'll be discussing a story actually not on the page. There was so much news yesterday and information. We're going to be covering the Bank of America gold and silver recommendations that have been circulating in the mainstream media. And we wanted to put a finer point on what we think is going on there. Also, we'll touch on Michael Oliver sat down with Tom Bodrovics, and we were there as well. And we discussed the things that you think we would discuss: metals, economics, geopolitics. Okay, so let's go through the markets first. 10 yields are up 2. The dollar is up 21. The S&P 500 is down 1.5. The NASDAQ is up 56. The VIX is up 21. Silver is 78, up a buck. Gold is 447, down 6 and change. Shanghai silver is lower, although that's not perfectly lined up. So the spread is tightening now, it would seem, at the higher level, which is what we thought would happen. But once it tightens, you have to be aware of what could happen next. Um, Copper is up 1.7%, up almost 10 cents. Metals war. WTI is down 9 cents, 58.34. Natural gas is 348, unchanged. Bitcoin is down 800, trading 90,000. Ethereum 3,000 and change. Palladium up 52, platinum up 17. Gold, silver down 1, and grains are mixed with wheat negative. Okay, Bank of America's 2026 outlook positions gold as a core portfolio asset, forecasting an average price of above $4,500 per ounce, driven by tightening supply, rising costs, and resilient investment demand. The bank argues gold remains under-owned across retail, institutional, and central bank portfolios, with optimal allocations closer to 20 to 30%. That's a lot, actually. Silver is framed as a higher beta extension of the gold thesis, with historical ratio analysis implying potential upside well beyond prior cycle highs. Okay. Considering that we've been watching Bank of America recommend gold to institutional clients for the last year, and this is the first time the report is coming out on the retail side, it makes you pause if you have healthy skepticism. Not necessarily bearish, but certainly uh, not something that their better and bigger clients didn't know about already. Now, modeling by the bank suggests that a 14% increase in investment demand would be sufficient to lift gold prices towards $5,000 per ounce, a threshold Bank of America views as achievable within the current macro environment. By contrast, just to put it out there, a move towards 8,000, which is another level they have, would require a substantially larger, though not unprecedented, 55% increase in investment demand. So if gold goes to $8,000, you're probably going to see a crash in stocks. That's where that comes from. Now, silver is very interesting. Excuse my cold. Using prior cycle lows as reference points, the bank outlines a wide but structured range of upside scenarios for silver. A reversion towards the 2011 ratio low of 32 would imply a silver price near $135 per ounce, while a return to the 1980 ratio low of 14 would suggest prices approaching $309 per ounce. Now, we have some opinions on this, and well, we have a price, and that price is $144, and that price is based on the behavior of uranium and based on the behavior of lithium when they were added to the critical minerals list. Those are the fundamental drivers of silver right now. Is the US government hoarding? Is it critical? Is the rest of the world also restricting flows? That gets the price to 144. Tomorrow, no. Over the next 50 months, yes. Over the next 6 months, nobody knows. Now, if you're looking at their analogs, which are the 2011 gold silver ratio, puts silver at $135 an ounce, and the 1980 ratio puts it at a price of $309 an ounce. They're both pretty reasonable. And what I mean is, we could average $135 an ounce over the next 2 years, and we could go as high as $309 an ounce, and that would still be below, Michael Oliver's levels, but even above my highest level. But targets don't matter. What matters is we're in an exponential move right now, so you can't measure exponential moves. You can only measure irrationality and signs that the irrationality is abating. And we're not in the irrational moment right now. If we were, we wouldn't be having this conversation. We'd be running around looking for silver in the couches. Maybe some of us are already. Anyway, the analysis covers gold, silver, miners, as well as base metals. It's actually pretty thorough, but there's always a but with me. Look, I'm speaking to the older guys here and the stackers. As someone who's bought the highs more than 20 times as a trader, and who's gone from hanging on every word that the banks say to being skeptical of everything to understanding the difference now, at least I think I do. I think that this analysis that Bank of America put out is completely genuine and completely sincere, and also interesting that they're doing it now. Meaning, I feel like either it's the old days and we're being set up to be holding bags. I don't really feel that anymore. Just saying I acknowledge that that's there. Or I think the whole country is getting ready to have product launched to tell people to buy gold. When you look at what's going on in the world, when you look at how the US ETFs are increasing investment, how banks are recommending gold, how Tether is talking about having gold as a payment unit, when you see the Middle East creating blockchain products for silver, when you see China reacting to this by restricting the exit of precious metals, the United States and the world in general is encouraging its citizens to own precious metals, if for no other reason, just to have it on shore, to confiscate it later, maybe. India, you're allowed to use your silver as a collateral to get loans now. The US, buy ETFs, Bank of America, everyone's saying come out and buy it. Tether, buying gold. And let's not forget, Judy Shelton, gold bonds. It feels like the whole country is being geared up for a war mentality. Meaning, during war, you had a direct request of nations to ration, to contribute, to buy war bonds. Well, okay, we're not at literal kinetic war globally right now, but it's the same mentality. The minerals are being called critical. Smelters are being built in the US. Banks are pulling concentrate out of Latin America. China is being thrown out of Latin America. Russian tankers are being stopped. China is restricting. This is the war. This is either we're preparing for a war or we're hoping to do this without having a kinetic war, which, by the way, this is egg fucking exactly what happened before World War One. Empires collapsed, nations were born, resources were fought over, and boom, an archduke gets shot. This is, I think, look, I'm saying this optimistically. I believe that the real leaders of our planet, let's, for this argument's sake, let's say China and the US leadership and the other nations involved, are coordinating a very complex deglobalization divorce. And if they succeed, we're going to have inflation, we're going to have problems, we're going to have skirmish wars, we're going to have a lot of problems. And if they fail, we're going to have a spark go off that can't be stopped. Maybe it's in Serbia again. Maybe it's in Armenia. Maybe it's in, I don't know, Latvia. Maybe it's in Latin America. You have all these problems. The US is pulling out of the world and retrenching its defenses domestically, which means everywhere the US pulls its policemen off the corner, you got a problem. Israel, right? Gaza. You've got Ukraine. NATO's out of there. You've got eventually China and Taiwan. Boom. Japan. Any place that we're receding global reach to protect ourselves domestically is no different than the Austro-Hungarian Empire when it collapsed after the Middle Ages, going into World War One. So you have a collapsing complexity, and you can hope for the best, and the best is separate but equal. The worst is, hey, you're taking my resources. I'm just saying, look, I'm getting all of that from a little Bank of America report, and you know what? I'm fucking right. Just the best we can hope for is the US comes out on top as the world reorganizes. This is the reset. The worst we can hope for is, our sons and daughters, our grandchildren, being drafted for the military. I think that, I'm not being cynical. I just, I hope people know what they're doing. Anyway, so buy gold and buy silver because there will be product coming out. Rant over. Thank you for listening. Uh, Yesterday's mini pod. Will next week's rebalancing kill silver's rally? The answer is no, but it could damage it. Zero Hedge asks. That was the podcast to that event, to that effect. Coming soon over the weekend. All right, Goldman Sachs pushed back against the silver thing. Zero Hedge wrote about that. They believe persistent LBMA problems will promise extreme price action. That means both ways, but we're going to write that up over the weekend. Deutsche Bank is now saying January is bullish for gold historically, despite saying that silver can have its problems. And we have been all over seasonality for a decade. And we've talked about it here for the last 4 years. And we're telling you January and February are the most bullish months on average, but they're also the most volatile months on average. So we're going to write this up. We're not going to throw water on it. It's correct. We're just going to give you the caution of where the easy money is versus the big money risk. Anyway, founders on Sunday, we're going to have Michael Oliver stop by and share his thoughts, and we're all going to get extremely bullish and go out and buy more silver afterwards. But that's it. We'll have the Flow Show walkthrough. Michael Hartnett, I think, is back, and lots more. Data on deck. Today is the unemployment report. Now, it'll be out by the time you see this, some of you. The jobs number, the non-farm payrolls number was consensus on the street was 59,000 for a couple weeks. But over the last 5 days, it's jumped up to 70,000. So the average is now moving higher. And I think the average is moving higher because people are looking at the small business index. The small business index is small business, are they hiring or not? And they seem to be leading, they're leading the unemployment situation. The unemployment situation seems to be turning upward again, which is what the government wants right now. So just know that the expectations of job recovery are growing even as we're talking about this. So just keep that in mind, whatever the number is. If it's above 70,000, below 70,000, watch what the market does. And please buy a hat, MAGA or MAGA or MALGA on the day. Let's take a look at silver. Okay, so I want to look at the silver chart because this is technical analysis. I'm not going to give you numbers. I'm not going to do that. Does this work? It does. All right, so here we have, that's the physical buying. Physical buying doesn't care about moving averages. Physical buying just buys a price, okay? This is, we'll call this the top of the range. So there's your new channel. We've had a lot of these channels over the last 2 years. You remember I've done one down here before. See that? I mean, that's a different channel, but same idea. I've done a couple in gold. Now, you heard me describe this as this is the range within the range, and now here we are up here. So if you're a technician, you're looking at this, what you should be looking at, aside from your actual numbers, is what structure is dominating right now. And the dominant structure is the dominant behavior. So you have the early structure that I saw was the channel. And that structure is still dominant. That's governing everything. But within the structure, you now have the lower range and the higher half. But note the higher half is more volatile. So I would put this to you. If you're trading the range, we're still in the range. If you're looking at this as two ranges, you're saying, okay, well, screw this second half of the range. Look at it this way. We're in the range, but now we have a new structure that's being built. And that structure is up, down. That long wick says we could go back up. So you look at it this way. We're in the range or up, down, up, down. Okay? So the range is either a continuation range or it's a top range. Nobody knows, but it's a range. So if you're short-term oriented, trade whatever you want. If you're longer term oriented, you're bullish, but not more bullish until we get above that level, which brings us to 92, if I'm right. If you're nervous or you're bearish or you're cautious, you just say, all right, you say what I said yesterday. We should go down to here. And we didn't. We stopped here. So unless we get below here, I'm not bearish. You follow? You want to be short? Fine. But you can't be short right now. Be short below here, trying to buy it here. Or be short below here, trying to buy it here. Don't be short in the middle of this range. That's just ridiculous, especially after leaving a long wick. Anyway, so two structures. You have a very volatile trading range with physical demand underneath, and you've got this trend that could just be oscillating. Elliott Wave people would see this better than me. But those are two structures. Then you go into your hourly or your 4 hour and you decide what you want to do. I'm Vince. It's Friday. Have a great weekend. Talk to you later.